Hello, and welcome to Own Your Retirement. My name is Albert Lalonde from Kaizen Financial. If you'd like more information about what you hear during our show today, give us a call at 586-752-7008 or visit us online at www.kaizenfinancialinc.com. That's Kaizen, Kaizen. And while on my website, click on our podcast page to check out our past shows and to subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. Okay, so today we're talking about something brand new and depending on your family situation, potentially very significant. We are talking about Trump accounts. Yes, they're a federally tax advantage savings vehicle for children created under the One Big Beautiful Bill Act, which President Trump signed into law in July of last year, 2025. Now, accounts just opened for funding on July 4th of this year, and there's already been a remarkable amount of interest, I would say, from families all across the country. So, for the first part of today's conversation, we'll be drawing from a Kiplinger article titled The GOP Trump Account for Savings. Your funding starts soon. And later in the show, we'll bring in some context from the IRS resource page covering the One Big Beautiful Bill provisions, which includes official figures on enrollment and obviously pilot contributions. And as usual, I am very glad to have my co-host Tony Shore here with me today, and so he can help us with his Trump accounts. And Tony, how are you doing, buddy?
Well, I am doing great, Albert. I've had a great week, and it's that time of year, and this year we're celebrating the 250th anniversary of
something?
America.
Yes,
Amazing,
that is
amazing. And Albert, I want you and our listeners and viewers out there to know I'm actually old enough. I should never admit this, but I'm old enough to remember the bicentennial celebration in 1976.
Nice.
Where they celebrated 200 years. I was 10 years old, and I remember going to this huge celebration, the 1776 Farm Fest 4th of July celebration. It was somewhere in Minnesota near the Twin Cities on this big farm. It was amazing. My dad took me. That was so much fun. But I'll never forget it. I mean, that whole year, everything was 1776, you saw.
Right.
And that was kind of neat. But here we are 50 years later. So, yeah, it is something. Well, how about you, Albert? How are you doing?
I am well. I was 5 when that happened, so I don't remember too much of the bicentennial.
Right.
But I say we just had our client annual appreciation barbecue last Sunday, and what a great turnout! And we had
that's awesome.
about 450 people arrived. Weather was great, not like it's going to be right now. And the rest of the week, we're going to be near 100 degrees. We have a weather heat wave warning, so. It all worked out perfectly last Sunday. So wonderful. And thank you to all my clients that attended. We had such a fun time.
Yeah. I think that's awesome. And I know you do that for your clients. And 450, that's a lot of people that you're entertaining right there and schmoozing with. That's great. I bet you had fun, though.
Yes, we did.
I heard there was an 80s theme. I heard we might see some pictures of Albert in a mullet wig and some 80s clothing.
I let my hair down that day. So.
Well, I'll tell you what. Let's talk about Trump accounts because, I know that no matter what side of the aisle you're on, I mean, people either love them or hate them. You kind of have to put the name of the account aside, the Trump account, and look at what this account is because there's some great things about these accounts if you have kids 18 or under. So I think we should dig into that. I mean, it's a new vehicle. There's a lot of noise around it.
Yes.
And the more I've read and the more I understand about it, the more interesting it becomes. So what exactly is a Trump account? And tell us more about it.
Yeah, great place to start. A Trump account, also called a 530A account, after the section of the tax code that actually created it. So again, is a tax-deferred savings account designed specifically for children under 18. Now, the IRS classifies it as a type of like a traditional IRA, but it operates under its own distinct rules during the child's first 18 years.
Hmm.
So, the idea behind it is, well, I'm going to just say it isn't entirely new. Democrats, because you mentioned before about the name Trump, but Democrats have proposed similar concept before, most notably Senator Cory Booker's baby bonds proposal, which also featured $1,000 seed money for newborns. So
Hmm.
that proposal was government funded and means tested, and it never gained the bipartisan support needed to actually become law. But then the Trump accounts, well, they take, let's say, a different approach. It's contributor funded, broadly accessible regardless of income, and built around market participation. So the stated goal, as supporters have framed it, is producing the next generation of investors. Now, here's the basic structure. Excuse me. A parent, legal guardian, or another authorized adult opens and manages the account on the child's behalf. The child is the account owner, but they have no access to the funds until they turn 18. So during that entire window from birth through December 31st of the year before the child turns 18, money goes in and it grows tax deferred and it stays put.
Okay, interesting, and I think one of the big things that people misunderstand because of the media coverage of this, and this is something I was confused on
Mhm.
before we talked about the research for the show, and I looked into it, is these accounts, you can open these accounts for any child 17 or younger.
Yeah,
Uh, Under the age of 18, you can open. They don't have to be newborns or born in the last few years.
right.
Let's talk a little bit about that. But you said tax deferred. First, I want to
Mhm.
ask, what does tax deferred mean in this context here with
Well,
these
it
accounts?
basically means the account grows without being taxed year to year as you're
Mhm.
growing it, which is a meaningful advantage over, let's say, a standard taxable account. But it's not tax free in the same way, let's say, a Roth IRA is. In fact, taxes come due when distributions are taken. So, similar to how a traditional IRA works. Now, there's a Roth conversion opportunity after age 18 that changes that picture significantly, which we'll get into later here, Tony. But
Sure.
one structural note: during those first 18 years, investments are restricted to broad US equity index funds or ETFs with expense ratios of only 0.10% or less. So there's no sector funds, no leverage funds, no bonds. The account is designed for long term growth. And honestly, low cost index investing has a strong track record now over long time horizons. So the restriction keeps the account focused, let's say.
That sounds great. I mean, everything I'm hearing about this sounds good. Now, and I think that structure makes sense.
Mhm.
I understand these accounts have already gotten a lot of attention, even before the official July 4th opening.
Yes, in fact, significant is an understatement, Tony. In fact, according to an IRS article, One Big Beautiful Bill Provisions, 4 million children have already been enrolled, and 1 million of those families have filed to claim the $1,000 federal pilot contribution.
Yeah,
Four,
and we're
m-
yeah, and we're going to talk about more about that here in a
yes,
bit
for
too.
sure. And that's where people get confused with the
Yeah,
media and what they're going about
yeah.
and who qualifies. And then 4 million children in a matter of months isn't a niche concept. It's actually a mainstream financial topic that families are actively asking about. So accounts are held at BNY, which Treasury designated as, let's say, the financial agent for the program, with Robinhood serving as the brokerage. So the Trump Accounts app, built by the two together, is available now on the Apple App Store and the Google Play, and is the easiest way to get enrolled. And that July 4th launch date, which is this weekend, was intentional because it's the 250th anniversary of the Declaration of Independence, obviously, what we talk.
Yeah. Yeah, that's great. Well, and let's talk more about who qualifies and clarify this for people and listeners and viewers. This is where you need to pay attention. Who
Yeah.
can open one of these accounts,
Yes.
and are there any restrictions on eligibility?
Well, eligibility is broad, which is one of the appealing features of this vehicle. The child must be under 18, a U.S. citizen, and have a Social Security number. At least one parent must also have a valid Social Security number or individual taxpayer identification number. Now, that's it. There's no income limit, no means test, no phase out like you see, let's say, with the Roth IRA contribution. If your child meets those basic criteria, they're eligible. And
Yep.
as for who can actually open the account, well, the IRS lays out a specific priority order for authorized individuals. So legal guardians come first, then a parent, then an adult sibling, then a grandparent. Now, one of those authorized individuals must open the account on or before December 31st of the year in which the child turns 17. And only one Trump account is allowed per child at any given time. The rollovers to a new account at a different institutions are permitted, Tony.
Okay. Okay. So, who qualifies for the account? Like you said, anyone who turns, they can have it if before December 31st of the year in which they turn 17.
Yep.
So, anyone that fits that criteria, and like you said, they have to be under 18, a U.S. citizen, and have a social security number. Then they can have a Trump account. Now, separate from that is this $1,000 pilot contribution. The government is going to seed certain accounts and give you $1,000. That's what most people hear about first. But who gets that and how? That's a different criteria.
Yes, it is. Children born between January 1st, 2025, so of last year, and up to December 31st of 2028, qualify for a one-time $1,000 deposit directly from the federal government. But here's the critical piece that a lot of families are missing. It's not automatic. The way you do that is simple. So download the Trump Accounts app on the Apple Store or Google Play, or go to trumpaccounts.gov. You can also elect it when you file your federal tax return using IRS form 4547. Any of those three paths gets you there, Tony. Now, this is one of the most important action items for any family with a child born in that 2025 to 2028 window. Don't assume it just happens on its own. You must choose it, and you want to do it sooner rather than later, folks.
Yeah. Yeah. And that's true. So don't assume, be proactive. And I think that's a good philosophy for all parts of our financial lives. Isn't it?
Yes. I think that's a great perspective, Tony. Okay. So now let's put that $1,000 in long-term context, because the compounding math is worth understanding. So let's say at a hypothetical 6% average annual return, and these are projections, not guarantees, folks, that $1,000 alone with zero additional contributions could grow to roughly $2,900 by the time the child turns 18. Now, keep it invested to age 40, and now you're looking at approximately $10,300. By age 59 and a half, that single $1,000 seed deposit could be worth around $32,000. That's the power of starting early, even with a modest amount. So, also worth knowing that the pilot contribution doesn't count against the annual $5,000 contribution limit, and it's excluded from the child's income, so it doesn't even increase their tax basis. It's generally free money, but only, again, if you go get it.
Right. There you go. And that's just the baseline you're talking about. What happens when families start adding contributions on top of that?
Oh my gosh, the numbers change dramatically. The annual contribution limit is $5,000 indexed for inflation after 2027. Now, these are after-tax contributions, so they don't reduce your taxable income the way, let's say, a 401k contribution would. But anyone can contribute on a child's behalf. Remember, parents, grandparents, or other family members, even friends. Employers can also contribute up to $2,500 per year per child of an employee.
Wow.
So employer contributions count toward that 5,000 combined annual limit. So if an employer puts in, let's say, 2,500, the family can add just another 2,500 on top of that for the year. On the employer side, those contributions are actually excluded from the employee's federal taxable income, which is a meaningful benefit for families who employers offer this.
Wow. Yeah. And I think as this goes on, more and more employers might add that as a benefit, as an incentive for employees. And there's also a category called qualified contributions, right? What does
Yes.
that mean?
Those come from charities or let's say government entities and
Mm,
don't count against the $5,000 limit.
wow.
That's the category where you'd see something like, let's say, a private foundation contributing on, let's say, behalf of a qualifying class of children. So if a family maxes out at 5,000 per year from, let's say, birth through age 17, plus claims that $1,000 pilot contribution, that account could grow to approximately about $157,400 by age 18 at
Wow.
that hypothetical 6% return, Tony. That's amazing, right?
Right.
And then by age 40, that would be around $567,000. And by age 59 and a half, well, it could be approaching $1.77 million. Now,
Wow.
again, those are projections based on hypothetical returns with no withdrawals, but they're illustrate what time and consistent dollar, what we call dollar cost um, average contributing can do when you start at birth. So
Yeah.
a couple of contribution details, though, you have to worth noting, understand, are that the annual deadlines is December 31st, not April 15th, the way IRA
Mm,
contributions work. There is no extended window, and contributions stop permanently on December 31st of the year before the child turns 18. And then one heads up for anyone contributing to a Trump account, like let's say the parents, grandparents, family members. There's an open question right now about how contributions interact with standard gift tax rules. And depending on how that gets resolved, a Form 709 filing could potentially come into play. So IRS guidance is still evolving on this. They're still trying to figure out which way they want to go. So it's a good reason to loop in, let's say, your financial service professional before you start writing checks. All right. Now, the workaround is to gift the money to a custodial account first, then transfer to the Trump account. So that's a detail worth discussing with a tax professional, obviously, before writing any checks, folks.
yeah. Wow, this is great information, and it's good to understand this because this sounds like a very great savings tool for our kids out there. But and it sounds like at 18, some decisions have to be made with the account because you can't contribute anymore to a Trump account after that age, after the child or whoever account that name is in
Mhm.
turns 18. So but let's give out our your contact info first. How can our listeners out there get a hold of you?
Yeah, of course. Folks, give us a call, 586-752-7008, or visit us online at www.kaizenfinancialinc.com. Kaizen, Kaizen. And here's why that matters in the context of today's show, having a complimentary consultation, because Trump accounts are new. The rules have real nuances, and the decisions families will make in the early years, like how much to contribute, what strategy to pursue at 18. How does this fit alongside, let's say, your 529 or other savings? And this all can have significant long-term impact. So that's why you have to have this type of conversation with a financial service professional.
Right. Well, Albert, let's now talk about that age 18 moment because
Yeah.
that's when the real planning decisions begin and live, right?
Yes, it really is. In fact, it's a pivotal moment. At 18, the account transitions fully to the child. Now, the investment restrictions lift, and they can now invest in whatever they choose, not just broad index funds, and they have several options for what to do with the account itself. So, first, they can keep it as a Trump account, treating it like a traditional IRA going forward. They can roll it, let's say, to a traditional IRA. They can convert it to a Roth IRA, or they can withdraw the funds subject to applicable taxes and, in some cases, penalties. Now, on the qualified distribution side, Kiplinger notes that withdrawals can be used for higher education expenses and first time home purchases up to $10,000. There are also provisions for specific situations like natural disaster related costs and expenses around the birth of or adoption of a child, let's say. Now, non qualified withdrawals before age 59 and a half are subject to a 10% early withdrawal penalty, similar to how a traditional IRA works. So the account has flexibility at the distribution end, but it also rewards patience, Tony.
Yeah. Yep. And like, you know what my mom says about patience? Patience is a virtue for which I can hardly wait.
There you go.
And you mentioned Roth conversions earlier. Walk us through that one because I think that's the thing that I hear a lot about from financial minds out there,
Yeah.
and something our listeners and viewers need to understand here.
Well, it's the strategy generating the most discussion among financial service professional, obviously, and with good reason. And so here's how it works. At 18, the child can convert the entire Trump account balance to a Roth IRA. Now, the conversion is a taxable event, and ordinary income taxes are owed on the amount that's converted. But if the parents cover that tax bill out of pocket, the entire account balance moves into a Roth and then compounds tax free for the rest of the child's life.
Wow.
No taxes on future growth, no taxes on qualified withdrawals in retirement. Now, let's put some numbers behind that so you folks can understand. A max funded account with the pilot contribution could be worth approximately $157,400 at age 18. If that gets converted to a Roth at 18 and continues growing at that, let's say hypothetical 6% return, it could approach 1.77 million by age 59 and a half, and potentially all of it tax free.
That would be huge.
That's a great generational wealth building opportunity that simply didn't exist before this legislation last year.
Yeah, what a unique account. I mean, that's great.
Mhm.
But I'm guessing there's a lot of nuance with timing, and
Yes.
timing with these things is always important too.
Yep. Indeed, there is. And if the child is still subject to, let's say, the kiddie tax rules at the time of conversion, which means their unearned income above a certain threshold gets taxed at the parent's marginal rate rather than the child's, converting too early could result in a larger tax bill than expected. Now, the general guidance is to time the conversion for after the child has established financial independence and is being taxed at their own rate. So for many 18-year-olds, that rate will be low, and which is actually another argument for converting sooner rather than later. But it's a calculation that depends on the child's individual circumstances. And it's exactly the kind of thing an advisor should model before the clients obviously pulls that trigger. And then one more item to flag here for you, Tony. For a child with a qualifying disability, the Trump account can be rolled to a 529, basically a ABLE account, but that rollover window is limited to the year the child turns 17. It's a one-time opportunity, and families in that situation need to have it on their radar well in advance.
Okay. Makes sense. Now, let's zoom out. How does a Trump account fit alongside other savings vehicles families use for their children, like 529s or
Mhm.
UTMAs, UTMAs, or maybe a custodial Roth?
Yeah. Well, the consistent guidance from many financial service professionals is that Trump accounts are an additive, not a replacement for existing vehicles that you just named.
Sure.
Each tool has a different job, and understanding those differences helps clarify where a Trump account fits. So, a 529 plan is purpose built for education. Contributions grow tax free when used for qualified education expenses, and many states offer a deduction for contributions. It's a strong vehicle if educating funding is the primary goal. Now, a UTMA or UGMA, so a UTMA or a UGMA custodial account offers the most flexibility with no contribution limits and no restrictions on what the money is used for. But earnings are taxed annually. There's no tax deferral, and a Trump account wins on the tax treatment side compared to, let's say, an UTMA. But now, a child owned Roth IRA is another comparison point. It offers tax free growth and tax free qualified withdrawals, the same as a converted Trump account, but a Roth IRA requires the child to have earned income. A 10-year-old with no job can't contribute to a Roth IRA, but a Trump account has no earned income requirement. So that's what makes it accessible from day one from birth.
Yeah. Well, so in practice, what's the framework here then?
Well, cover the college savings needs with a 529. Address near-term flexibility with, let's say, an UTMA if needed, and then layer in a Trump account as the long game, generational wealth vehicle. For clients who have those other, let's say, bases covered, a Trump account becomes the natural next conversation. But now be careful. Be aware that California Hawaii, Kentucky, Massachusetts, Pennsylvania, South Carolina, and Wisconsin plan to tax annual Trump account earnings at the state level. Details are evolving, so check with the tax pro if you reside in one of those states I just mentioned. The federal tax benefit still applies in those states, but the full net return picture looks different. So it may be worth running those numbers with your financial service professionals if you live in those states I mentioned.
Yeah. Yeah, there you go. Well, I think that's really important. So, where do you fit in, Albert? Where does a financial professional like yourself fit into all of this? Because as you mentioned, clients can open these accounts on their own by downloading the app, correct?
You're exactly right. In fact, the account opening itself is accessible. A parent can go to trumpaccounts.gov or download the app, file form 4547, and get an account established. What they can't do on their own is everything that comes after: modeling the Roth conversion timing, navigating the kitty tax rules, and figuring out the optimal conversion window for their child's specific situation. Integrating the Trump account into the client's, let's say, overall financial plan alongside their 529s, let's say their UTMAs, their own retirement accounts. So thinking through the potential gift tax implications for contributions as well, and then flagging the state level tax picture for clients in those 7 states mentioned. So none of that happens at BNY or Robinhood. So that's why you folks have to be proactive with a financial service professional to help you with all those things.
Yeah.
And then there's the age 18 handoff itself, which is really a planning event as much as an account transition. And 18-year-old suddenly in full control of what could be a 6-figure account. Well, I would say they may need some guidance on their options. So do they convert to a Roth? Do they roll it to a traditional IRA? Do they take a distribution for qualified expenses? What are the tax consequences of each path? What does the right move look like given their income, their plans, and their long-term goals? So that's not a decision a teenager should be making in isolation, Tony.
No, obviously not. So remind us of some of that data from the IRS here before we go.
Yeah, according to the IRS, 4 million children are already enrolled. That's 4 million families who are going to have questions over the coming years about annual contributions, about the Roth conversions, and about how this all fits together. So make sure working with a financial professional, wow, it can really help answer many of those questions for you guys.
I know that's great. Now, this has been a great show talking about Trump accounts. They're that new federally tax advantage savings vehicle for children under 18. You talked about how as long as somebody's under 18, there's that $1,000 that children born between 25 and 28 are eligible for. So no withdrawals allowed before 18. It's just, and at that time you can roll it into another account. Great conversation today. But before we go, let our listeners know how they can get a hold of you. Don't make a move on this without talking to a trusted financial professional first.
Sure. If any of today's conversation, folks, is raising questions about your own family situation or your client's situation, we'd love to talk it through with you. Give us a call at 586-752-7008 or visit us online at www.kaizenfinancialinc.com. That's Kaizen, Kaizen. And we'll put together a whole summary and show you guys what makes sense for you. And so remember, it's our job to help you be educated so you can own your retirement, folks.
There you go. Well, Albert, thank you so much. Listeners and viewers, thanks for tuning in. That does it for today's episode of Own Your Retirement Podcast with our host, Albert Lalonde.
Take care, everyone.